Cameras on, please. So we are still talking about allocations of tax items. So again, we are in the situation where the partnership has recognized tax items, items of gross income or gain or loss or deduction. And those allocations are going to flow through to the partners and be reported on their own individual returns. And now we're focused on the question of which partner gets which. And 704A and B tell you that you first look to the partnership agreement and see where the partnership agreement says allocations go. And then you can test those allocations for substantial economic effect. And you start with economic effect to see whether there's economic effect, and then we'll move on to substantiality. And the principle of economic effect is to tether the allocations to the economic deal. If you get allocated income, that's supposed to be good for you from an economic perspective, a pre-tax economic perspective. If you get allocated, and allocating income is bad from a strictly tax perspective because you're going to pay more tax, but we're focused here on, does it match the pre-tax economic deal? So if you get allocated items of positive items, income and gain, that's got to be good for you. If you get allocated items of deduction or loss, that's got to be bad for you, both from a pre-tax economic perspective. And so how does economic effect do that? Well, the general test, which we talked about last class, is pretty straightforward. I mean, you can determine whether the general test is satisfied by just looking at the partnership agreement. And it requires you, the partnership agreement, to satisfy three things, the big three. The capital accounts have to be maintained according to the rules. And then those capital accounts then have to be meaningful, which means that upon liquidation of the partnership's interest, prong 2 says distributions on liquidation will be made in accordance with positive capital accounts. And prong 3 says if you have negative capital account on liquidation, you have to repay that amount back to the partnership. And so that ensures that if you get allocated income, your capital account goes up by the amount of that income. And that's good. That increase in your capital account is either going to increase your rights to liquidation payments or decrease your obligation to make payments on liquidation, and vice versa for losses. And just to put this in some context, if you could have a situation, let's say A and B are partners, and A has net operating losses as far as the eye can see. So A is not worried about taxes. A is Uber, right? Uber's lost billions and billions of dollars. They've got they're not paying taxes for a long time, if ever, Uber. So if Uber is partner A and a high rate individual is partner B, without the economic effect rule, if we just let the partners allocate it, Uber would say to B, it's like, you want these losses? You take them. Just take them. I don't need them. Now, you'll pay me for them in some way so that I'll benefit from it, but I don't need any more losses, so you take them. And what economic effect says is, well, you can't really just do that, because if B takes all these losses for tax purposes, B's capital account is going to go way down. And when B's capital account goes way down, that's going to mean something on liquidation. Okay, does that make sense? Any questions on any of that? Okay, as we talked about, the big problem with the general test and why it's not seen in practice very often is because limited partners or LLC members, partners with limited liability, their deal generally is, I know what I'm exposed for. I know the amount that I can lose, the maximum amount I can lose. I can put money in, and I know I can lose that. I might have an obligation to commit more money, but it's going to be a fixed amount. And I don't have this unlimited obligation to kick in money. And if I have a negative capital account, if I have an obligation, unlimited obligation to restore negative capital account, I then basically become a general partner, because I'm exposed. If the partnership borrows a whole bunch of money, loses that money, allocates the loss to me, I've got this huge negative capital account, and now my partnership agreement says I have to restore that on liquidation. So the limited partners, or again, LLC members, I'll just use, say, limited partners now, but note that that includes LLC members, basically all members of tax partnerships that don't have unlimited liability. They're just not going to, that's a non-starter to have an unlimited deficit restoration obligation. So they'll say, yeah, my capital account will maintain capital accounts, will liquidate according to positive capital accounts, but I do not have an unlimited obligation to restore. So the reg writers knew that, and they didn't want to write a bunch of regs, these intricate regs that are, impractical. So they created this alternate test. So let's take a look at that now. So this is 1.704. Let's start with a general test again, just to refresh ourselves. This is 1.704-1B2, two little i's, right here. This general, actually 2 little i's B, these 3 requirements, the big 3. And again, 1 and 2 are pretty manageable. 3 is a non-starter, oftentimes for limited partners. Okay, so the alternate test is just a couple, is the next page, -1B2, 2 little i's D, this alternate test for economic effect. So this test is actually pretty straightforward. Students have a tough time with it. I think there's a lot of cross references and a lot of language, but it's really not that hard. And so I think, again, if you really struggle with the language, you'll eventually get it, and then you're on to the next thing. So alternate test, if requirements 1 and 2, that's the first 2 of the big 3. So if you have maintenance of capital accounts and liquidating distributions according to positive capital accounts, and the second condition, the partner to whom an allocation is made is not obligated to restore deficit balance in his capital account. So if the first 2 of the big 3 are satisfied, but the third is not, which is kind of like, it's pretty obvious. Why would you need to have 2? Why would you need to have an alternate test if you met the general test? So that doesn't tell you much. 2. 3, the partnership agreement contains this qualified income offset, a QIO. I'm just going to bracket that off for now. Most students sometimes think that that's the really important part of this, and it's not. It has to have this provision. We'll talk about what the provision is, but it's really ancillary to the core aspect of the alternate test. The next thing is, so if we have those 3 requirements, let's assume we do. Meet the first 2 of the big 3, fail the third, we have this QIO in the agreement. Then it says such allocation, which is an allocation to the partner that we're testing, will be considered to have economic effect to the extent, this is the key language, to the extent such allocation does not cause or increase a deficit balance in such partner's capital account. So if you have an allocation to a partner and the big 2 are met, 2 of the big 3, first 2 of the big 3 are met, but you don't have prong 3, if the allocation doesn't result in the partnership going negative, then it still is consistent with economic effect. It's still going to reduce a positive capital account balance to another positive capital account balance, which means it's going to reduce your right to distributions, or it'll increase your capital account, whether it's negative or not. And in both cases, you're going to benefit from that. Well, let's strike that. If you're positive, an increase is going to help you. And then there's this parenthetical, in excess of any limited dollar amount that the partner is obligated to restore, right here. So we'll talk about that in a second. So again, imagine a bank account where if you overdraw, you don't have to restore the negative bank account. That's kind of like what we're dealing with here. Well, if your bank account goes down from $10 to $2, that you feel that. If your bank account goes down from $2 to negative $1, you feel $2 of that. But then when it goes from 0 to negative 1, you don't care because you're in this unusual situation where you don't have to repay your overdrawn bank account. And if your bank account goes from negative 1 to negative $1 billion, you don't care. Below 0, it's just funny money at that point. And so that's what this is getting at. Any questions thus far? Let's see how this works in that reg example. So we're going to toggle between this alternate effect language and this reg example 1.704-1B5, which is our list of examples. And then we're in example 1. So let's flip there. And we've seen, we're going to go through these just sequentially. We've got example 1 little I, we covered that. And that was a situation where the partners specially allocated all the depreciation. They're equal partners in all respects, except for one. They allocate the depreciation entirely to A. Again, A could be that partner that cares about deductions, and B is Uber. And they said, we're going to maintain capital accounts. We're going to also allocate all depreciation to A, but all distributions, whether liquidating or not, are going to go 50-50. And what we concluded there was that that allocation in the agreement lacked economic effect under the general test because it didn't have prong 2 or 3. It also lacks economic effect under the alternate test because prong 2 is not satisfied. So it lacks economic effect under both tests, and therefore we reallocate under the partner's interest in the partnership. We're going to talk a little bit more about PIP today, but this is an easy PIP. If everything's 50-50, you contribute 50-50, all distributions are 50-50, that's your easy PIP case where your allocations have to be 50-50. Okay, so we covered one little I before. Any questions on that? 2 just says, okay, well, we're going to liquidate according to capital account balances, but only if the partnership is liquidated during the first 5 years. And then liquidation distribute, anything will be equally. Well, that also fails both tests. It fails prong 2 of both tests because it has to be for the full term. Capital accounts the liquidation via capital accounts has to happen throughout the partnership term. And so this fails that. And again, you'd reallocate under PIP. This is a harder PIP reallocation. And it likely depends on, let's put it this way. If there's a high degree of certainty that the partnership's going to last at least 5 years, so we're going to get into that 50-50 liquidation, then it looks like before it's going to be 50-50. If it's likely to be liquidated within 5 years, then the capital accounts will control, and then it's more likely that the allocation to A would be in accordance with PIP. But we need to know a lot more facts. And one of the problems with PIP is, again, there's not a whole lot of guidance about this. It'd be hard to give a tax opinion to your client with any degree of certainty about what the right allocation would be. Okay. Any questions on 2 little i's? Okay, we get into 3 little i's, and this is the alternate test. So again, same thing. We're specially allocating the depreciation to A. Now, we're going to maintain capital accounts, but we're going to satisfy prong 2. We're going to liquidate according to positive capital account balances. So now we have 1 and 2. We have this QIO, which I bracketed off for now. We have some other language that will become important later, but now, because we meet the first 2 of the big 3, and we have this QIO, now we ask, does the allocation to A drive A's capital account below 0? And the answer is it doesn't. This is what this shows. The capital account would be reduced from 40 to 20. And so, because it doesn't drive it below 0, the allocation has economic effect under the alternate test. Okay, any questions about the technicality here? I'm going to step back and explain sort of why this makes sense. Any questions? Okay, so one way we can kind of check and see if this makes sense is, well, what if we had a liquidation of the partnership for book value at the end of the prior year? Where would the cash go? How much would each partner get? And then compare that to a liquidation at book value at the end of the current year and see where the cash goes. And then we can compare the two. We could say, see who bore the burden of the tax item in question. So let me put a balance sheet up here. So this is hypothetical. So we got, here's our A, we got B. These are capital accounts. And they each put in 40. They buy this equipment. And its book value is 80. And then in year 1, there's 20 of depreciation. And our year 1 allocation is 20 to A. Remember, all the other tax items offset. So whatever other cash operating income and operating deductions net to 0, so we don't allocate anything to B or anything else to A. And that's a device we'll use to keep things simple throughout this course. Just focus on this allocation. So what if we had liquidated? So we got hypothetical liquidation at book value at the end of year 0, which is, let's just say at the December 31 of year 0, they put the 40 of cash into the partnership each. And then on day 2 and January 1 of year 1, they buy the equipment. And this is the allocation again on the end of year 1. So if they liquidate at the end of, at the book value at the end of year 0, the capital accounts would just have been 40 at that point. And the partnership would just have 80 of cash. And so if they liquidated at the end of year 0, it would go 40 to A and 40 to B. We just basically reverse out the contributions. Right? So before really anything happened, we just give them their money back. Now we have this hypothetical liquidation at the end of year 1. Well, again, in these hypothetical liquidations, we're using book value. So we have 60 of book value. Because the partnership liquidates according to positive capital account balances, where would the 60 go? It's going to go 20 to A and 40 to B. We compare these two, and you say, oh, B is in the same place. A has suffered by 20. That's consistent with him getting allocated the 20 of deduction. A bore the burden, the economic burden of the depreciation in full. So it makes sense that he's entitled to the tax depreciation. Okay, that makes sense? We'll do that several times today and next few days. Any questions? You can raise your hand, just speak up, use the chat function.
I have a terminology question. Cost recovery deduction, the same thing as depreciation for?
Yeah. So cost recovery is generic for depreciation and amortization. Depreciation for hard assets, tangible assets, amortization for intangible assets. I would oftentimes just say depreciation, but yeah, same thing. Okay, let's go back to the examples. Let's look at the next one. Well, yeah, let's look at the next example. Change one fact. Same facts as in 3, except now the depreciation is $25,000. But what happens now? So we change this. So here, so now I'll just clean this up. We're going to deal with, so again, as a device to keep things simple, when we have depreciable property, it's going to be, we're going to do straight line depreciation. So just, if it's 80, I'll tell you it'll be 4 years, it'll be 20 per year. I'll tell you, you'll know the recovery period and just spread it out over that period of time. There's not going to be any conventions. We're going to do everything on January 1. So you don't have to worry about half year or whatever. It'll be simple. In the real world, we have accelerated depreciation. So depreciation can be different in each year. And so here's an example where it's not going to be straight line because it's 25 depreciation in year 1. So again, H contributed 40. I'm sorry. Yeah, sorry. This was the same facts. The year 1 was still 20. Year 2 is 25 under the facts. So we had year 1 was 20, and we said that that's valid under the alternate economic effect test. And we have to test for substantiality that we're going to bracket that off for now. So it has economic effect. We go to year 2, and we can kind of put it on the board to see. And what would happen is this would drive A's capital account to -5, and B's would be 40. And so we're testing this allocation now. And we asked, does it drive A's capital account below 0? And the answer is yes. We'd also ask if there's any, what we call a limited deficit restoration obligation, an LDRO. We'll talk about those later, but here there's no LDRO. An LDRO would support you to go below 0 to some extent, but here A can't go below 0. So the reg says that to the extent, the alternate economic effect reg says that it's valid to the extent it does not cause or increase a deficit balance. So 20 of this is valid under the alternate economic effect test. 20 is. 5 is the problem, that extra 5. Okay, so we can say for year 2, 20 of the 25 has economic effect on the alternate test. The extra 5 has to be allocated according to PIP. Okay? Does that make sense? For that, we have to go on and deal with that 5. And that's the to the extent language. Go back to the reg. This is to the extent right there. That's what tells us that 20 is okay on the alternate test. Okay, let's talk a little bit more about PIP, because now we have to reallocate the rest under PIP. And so the PIP rule is found in 1.704-1B3. We're in -1B2. So you go down to -1B3, which is about 10 pages or so, 13 pages or so forward. Oh, no, sorry. It is, actually, it's the next page. It's that page. So it's just down here. No. I had it right. About 10 pages forward. -1B3. So about 10 pages, 12 pages after the alternate economic effect test. And the heading is Partner's Interest in the Partnership. And we have some general throat clearing stuff. The manner in which the parties have agreed to share the burden doesn't really tell you much. Doesn't tell you much here. Here we got our sentence Scalia would love. All the facts and circumstances relating to the economic arrangement. Trying to understand the economics of their deal. And all those economic facts and circumstances are irrelevant. And here are some facts that are relevant, but no weighting of these factors. Their contributions, their interest in economic profits and losses, cash flow, that's operating distributions and non-liquidating distributions, operating distributions, and then liquidating distributions. There's a whole bunch of facts. Again, in a simple fact pattern, it's pretty easy. Everything's 50-50, then PIP is 50-50. But here's one special PIP rule. That's what I refer to as a special PIP rule that applies when we have these alternate economic effect failures where we're driven too low. So there's certain determinations. -1B3, 3 little i's. Again, our special PIP rule. And it gives us some certainty. It says if requirements 1 and 2 of the big 3 are satisfied, and all or a portion of an allocation of income, gain, loss, deduction made to a partner does not have economic effect. So that's us, that 5 that we're, that we haven't blessed yet with economic effect. We haven't blessed is what that's talking about. Then it tells you how to determine the how to determine where the allocations go under PIP. And it's a long sentence, but it's basically what we did before. We're going to compare a hypothetical liquidation for book value at the end of the prior year, see what each partner would get, and compare that to a hypothetical liquidation at the end of the current year, and see which partner would get what. Okay, so let's do that. So here we're comparing, because we're in year 2, we're comparing year 1 to the end of year 2. So now we've got our year 2 hypothetical liquidation. Well, first thing we would say is that there's 35 of cash to be distributed. And A's capital account under the agreement is -5 and B's is 40. That's the way it appears, certainly. And so what would happen is we know pretty easily that B would get all of it, all the cash, and no more. I mean, B could start harassing A and sue it, send them threatening letters and so on. Your capital account is negative, but A would defend simply, would say, look, our agreement says I don't have to repay my negative capital account. So B is left with just 35 and A is going to get nothing. Right? Everybody understand that? I mean, it's a real world, like, ask what would happen if the partnership were to sell its property for book value at the end of each year, year 1 and year 2. Who would get what? It's not tax. So where does the cash go? And so then we compare these two. A goes from 20 to 0, and B goes from 40 to 35. Well, A going from 20 to 0, that's this. B going from 40 to 35, that tells us that the missing 5 of depreciation is going to go to B. And so the bottom line here is that of the 25 of depreciation, 20 is going to be allocated to A, go on A's tax return. 5 is going to get allocated to B and go to B's tax return. That's not what the partnership agreement says. Right? The partnership agreement says it all goes to A. Okay, any questions on that? Now, let me just tell you something else. What a partnership agreement will often say, because they'll know, that they don't want their allocations to be, well, let me say 2 points. They don't want their allocations to be invalid. That typically what this partnership agreement would say something like, all depreciation to A, however, any depreciation that would be allocated to A that would drive A's capital account below any LDRO shall be reallocated to B. Okay? And so that's like a built-in sort of a fail-safe. And if that's the case, the analysis is the same. It's kind of simpler. It would just say, A, under the agreement, A gets 20 and B gets 5. We wouldn't have to go through the PIP stuff. So that's pretty common, and we'll see that in later circumstances where the partnership agreement itself sort of will have a built-in mechanism to where they won't allocate anything to A or B, anybody that'll allow them to get too low. Okay, so that's one point. The second point I want to make is students will say, well, obviously that 5 of depreciation has to go to B. We've determined it can't go to A. And that's right. That's good thinking. It's good logic. And then the next thing will be, well, in an exam, can we just say, the other 5 goes to B? We have to go through the PIP stuff. And my answer is, I want to go through the PIP stuff because in the real world, we may have more than one other partner. It may just be that for testing purposes, I want to limit it to 2 partners, and it's sort of obvious where it goes. But in the real world, it's not so clear. Again, if there's more than one other partner, then you can't use that process of elimination. And so even if there's one other partner, go through, explain to me why B gets the 5, not just because it can't go to nobody else, right? I mean, I give you partial credit, but to get the full answer, you need to go through the PIP stuff here. Okay, any questions on that? So let's just see. Again, if this is, it's hard, I know. But luckily, you know, the fact patterns are pretty short and uncomplicated, and you have, you know, the question and the answer. I mean, it's a little more summarized, but it, you know, this is what the reg says. What we just did is what the reg concludes. It does the hypothetical liquidation under the special PIP rule. Okay, I'm not hearing any questions or seeing any questions. All right, we'll go to 5. So in 5, it's the same fact pattern, except the year 2 depreciation is 20, and then we sell in year 3 for 35,000, or yeah, in year 3 for 35,000. So let's change these facts on the board. So the year 2 depreciation is now 20. Under the agreement, that gets allocated to A, and that's valid to A. It satisfies the alternate test. First 2 of the big 3 satisfied, doesn't drive A's capital account below 0. So it's valid, it has economic effect in its entirety. Okay, that's year 2. Everybody got that? I would go to year 3, and on January 1 of year 3, the equipment is sold for 35,000. So the book value at the time of sale is 40. So the amount realized is 35. The adjusted basis, the adjusted book value is 40. So we got 5 of loss. Under the agreement, everything other than depreciation is allocated 50-50. So losses on the sale of property is not specially allocated all to A, it's just 50-50. So in the agreement, we would allocate it 2.5 and 2.5. And we ask on the alternate test, does this allocation impermissibly drive A below 0? The answer is yes, it does. In its entirety, because it was 0 before, so it goes from 0 to negative 2.5. So it lacks economic effect under both tests. And we allocate under PIP. And under PIP, again, we look at the hypo liquidation at the end of year 1, end of year 2. Pretty simple. If we liquidate at the end of year 2, we'd have 40 of proceeds. A's capital account, if we stop right there, is 0, and B's is 40. So go 0 to A, 40 to B. If we have the hypothetical liquidation at the end of year 3, we've got 35 of cash. This is off the board. We've now got cash of 35. Where does it go? Again, the capital accounts under the agreement look like this. So we know all the cash is going to go to B, and that's it. So A is going to get 0. B is going to get 35. So compare A's to B. We say B bears the entire 5 of burden. And so this is going to get reallocated to B. And so B is going to get the 5 of loss. So that B will report the entire 5 of loss, not 1/2 of the loss. 2.5 of the loss is allocated to B under the agreement, and that's okay. I mean, I forgot to mention that. This allocation to B is fine because it doesn't drive B's capital account below 0. A's 2.5 gets reallocated and shifted over to B under PIP. And it matches the economics. Again, for A, that 2.5 of loss, again, it's like your bank account going from 0 to negative 2.5 when you don't have, again, assuming in this other universe where you don't have to pay back your bank when you go negative in your bank account. Okay, any questions on that? That's 5 little i's. Let's skip ahead to example. So we did 5. We're going to skip 6 for now. And we're going to go to uh, 7. So same facts as in 4. 4 was 20 of depreciation year 1, 25 in year 2. Except we changed one little fact, except that now the partnership agreement is obligated, where we obligate each partner to restore. So we satisfy the big 3. Well, now the allocation, let's go put it back, show you where we are here. We're back to this. Let me just start over. So here we've got A and B, they each contribute 40. Year 1 is 20. Year 2 is 25. And we've got our equipment is 80. Year 1 is 20. Year 2 is 25. And let's get focused on year 2. A's capital account is negative 5. B's capital account is 40. Well, now, if we sold the property for 35 for its book value, we'd have 35 of cash. It would all go to B, and A would now have to kick in 5, and that 5 would then go to B. And so under the general test, this is obviously, these are valid under the economic effect, the general test, but economically they match up, which is because again, every dollar that A goes down by increases his obligation to restore if it's negative. So in 7 little i's, it's just the general test. So valid under the general test. The big 3 is satisfied, right? Questions on 7? So that's not all that interesting. Let's go to 8. 8, now it's not an unlimited deficit restoration obligation. It's a LDRO, a limited deficit restoration obligation. A says, okay, I will restore deficits in my capital account, but only up to 5,000. Again, that's consistent with being a limited partner. I know how much I'm exposed for. I know my worst case scenario. It's what I put in and then another 5,000. So back to the same facts as in 7. And now, again, we're testing, under the year 1 allocation is valid. Under the alternate test, the first 2 of the big 3 is satisfied. It only takes his capital account down to positive 20. So year 1 is good. Year 2 is more interesting. Year 2 says we now take him below 0. So now we ask, is there any limited deficit restoration obligation that would support him, A, going below 0? And the answer is yes. There's explicit LDRO. If the partnership were to liquidate, A's capital account -5, A would have to kick in 5. So it would be valid on the alternate test now because he has this LDRO. And again, this makes sense. It's just, if we liquidate at the end of year 1, for book value, we'd have 60 of cash. It would go 20 to A and 40 to B. Liquidate at the end of year 2, it would go -5 to A. A gets a negative distribution, if you will, because A has to kick in 5, and B gets 40, right? The 35 of cash proceeds on the sale, plus A kicking in the 5, that gives 40. It's all going to go to B. So again, we compare these two. Well, B is in the same place, and that's consistent with B not getting allocated anything. A goes from positive 20 to -5. A suffers by 25, and that matches up with his allocation. You don't have to do this test here. There's no reason. The answer is the alternate test is satisfied. I'm doing this to show you that it makes perfect sense. Okay. Any questions on 8 little i's? All right, moving on to 9. So again, same facts as 4, except now A contributes a promissory note of 5. So A has no unlimited deficit restoration obligation. A has no explicit LDRO, but he signs a promissory note. A says, I promise partnership to pay you $5,000 in the future, and no later than my liquidation of my interest. So at some point, I'm going to be kicking in, A is going to be kicking in this 5. Okay. So this requires a little bit more analysis because there's no explicit LDRO, but what does this promissory note do for A? Let's go to right above the alternate test, 1.704-1, so it's -1 B2 2 little i's C. -1 B2 2 little i's D is the alternate test. -1 B2 2 little i's C tells us some more about LDROs. So it's right above that. It's the page before the alternate test, C. And I have to say, it's a very weird placement of this. This is what defines LDROs, or expands what is an LDRO. And it comes before the alternate test. So it's in C, and the alternate test is in D, but it's only relevant to the alternate test. So that's weird. It should be reversed. But anyway, notwithstanding that. So it says, if such partner is not expressly obligated to restore the deficit balance in such partner's capital account. That was the case in 7 or 8. It was just an explicit, just said to restore capital account. Such partner nevertheless will be treated as having an LDRO to the extent the outstanding principal balance of any promissory note contributed to the partnership by such partner. So your promissory note counts as an LDRO. And by the way, if there's any obligation to make subsequent contributions. So these are kind of like deemed LDROs. You're not literally obligated to restore deficits. You'll have something in your partnership where you say, I'm not obligated to restore deficits. But these things are treated like LDROs. So let's go back to the problem. What that tells us, again, it's the same basic facts. And the question is whether A's promissory note supports A going below 0. And the answer is yes. That 5 of promissory note supports A going below 0. To the extent of the promissory note, the principal balance, which is 5. So in 9 little i's, this allocation is valid in full because it doesn't take A below its LDRO amount of -5. Okay, that's the technical answer. Does this make sense? Yes, it does. Again, we do this thing. The year 1 liquidation hasn't changed. What happens when we liquidate in year 2? Well, in year 2, what's going to happen? End of year 2. What's going to happen is they sell the equipment for 35. A is going to contribute the 5 of capital promissory note. It's going to satisfy the promissory note. That's a capital contribution. Takes A to 0. Now the partnership has 40. It's all going to go to B. And so in liquidation, B gets distributed 40. And again, that's the same result. B gets 40 of cash from the liquidation. A has to kick in 5 via the promissory note. So we've seen 2 types of LDROs. One, where it's just explicit in the agreement. I have to restore deficits, but only to the extent of X. That doesn't satisfy the third prong of the big 3. The third prong would be I restore deficits, period. All deficits, unlimitedly. I don't think that's a word in English, but tax lawyers will use it, unlimitedly. But if it's a limited, explicit, then it's an LDRO. That's pretty obvious. If a partner contributes his own promissory note, that's also an LDRO. It's a deemed LDRO under that Reg -1B2 toolized C. Okay. Questions on any of that? All right, let's go down to 10 little i's. One more example of an LDRO. Here. Same facts as in 9. So where we have the promissory note, except that it's instead of A writing a promissory note to the partnership agreement just says, A, you're going to have to make an additional 5,000 contribution to the partnership. The earlier of the partnership's 4th year or when your interest is liquidated. Deferred capital contribution requirement. And really, in some respects, in many respects, identical to a promissory note. Probably easier if the partnership wants to sell the promissory note, to sell that to somebody else, whereas to sell a deferred capital contribution, there's no instrument, but it's just A is obligated to kick in $5,000 in the future. So we know A's capital account is going to go back up by 5 at some point in the future. And so this is an LDRO under that second part of the LDRO definition. This is the amount of any unconditional obligation of such partner, whether imposed by the partnership agreement. Here it's imposed by the partnership agreement to make subsequent contributions, other than pursuant to a promissory note. You don't get to count it twice. Promissory note goes here. Non-promissory note obligation to contribute is considered here. But we're back. It's basically, it's the same analysis in 7 little i's, 8 little i's. I'm sorry, 8 little i's, 9 little i's, 10 little i's are all just different illustrations of LDROs. 8 is a explicit LDRO, 9 is a promissory note of the partner, 10 is a future capital contribution requirement in the partnership agreement. Okay, questions on that, on LDROs, any of that?
Yeah, I have a question. So I saw in the book and then in the reg where it says something about state and local
Yes.
laws requiring you not to have that. Is there anything in Georgia for a partnership agreement that requires that?
Yeah, no, it's actually, so that's a little trickier. We may get into this a little bit later. What that's getting at is like, if you're a general partner of a partnership, then if the partnership assets are not sufficient to satisfy the debts of the partnership, then you're responsible. You have to kick in that money. And so that is what supports a general partner going below 0 to the extent the liabilities exceed the book value. So that's what that's getting at, that vicarious liability in general partner for partnership recourse debts. Or you could have a partner guarantee of a debt. So it's not specific. It's not nothing in state law that I'm aware of will say you have to contribute money to the partnership, but it is a implication of a partner's contractual or state law obligation to satisfy the entity's debts, vicarious liability. We may talk some more about that. Good question. Other questions at this time? All right, now I know that's a lot of words, and I know, it's easy for me because I'm really comfortable with this stuff, but it's really not that hard. That's really not that hard. I encourage you to work with the language, go through those examples, go through the examples in the text. We're going to go through, once we do economic effect and substantiality, we spend the whole day on a review problems. So we're going to go through this again. You just got to kind of work with it. But what I'm going to talk about now is kind of the hardest stuff. It's the hardest part of this. And it's not really all that important. So let's not get lost in the weeds. But let's go back to the alternate test. -1B2 toolized D. And we stopped here. We said, okay, first 2 of the big 3 don't have the big 3, don't have the third, but you got this QIO, which we still haven't talked about. Then such allocation, you see, you look at, does it drive the partner's capital account below 0 or below the LDRO? That's the LDRO language. We haven't talked about the next sentence, which begins in determining the extent to which the previous sentence is satisfied. And so before we get into the language, let me talk about what the reg writers were concerned about. So remember, your capital account goes down when you get allocated losses and deduction. And we can stop that to go negative, to go impermissibly negative. I'm referring to impermissibly, I'm meaning not supported by an LDRO. It's easy to do that. We just won't let you take those losses. They won't go to you. They take you too low. But what about distributions? Say distributions of cash. They're going to drop your capital account below zero, or they're going to reduce your capital account, certainly. And they may very well reduce your capital account below zero. And again, just assuming there's no LDRO, when you get below zero, it's just funny money. It makes, there's nothing there. So what do you do then with distributions? That's a real problem. We can stop tax losses from going to you because that's a tax thing. We can't really stop distributions going to you. I mean, I guess we could. We could have a law in the tax law so that you can't take a distribution if it would drive your capital account below zero. But that wasn't the way the reg writers went. And so what they decided to do is they said, look, we're going to look into the future. When we're seeing how low your capital account can go, we're going to look into the future. We're going to get our crystal ball out. We're going to see if on the horizon there's any future distributions that we have to worry about that are going to happen. And if there is, we're going to effectively build a cushion into the capital account to make sure the distribution won't take you impermissibly low. So an analogy that I use, I'm not sure how good it is, would be, let's say you're renting an apartment and the rent is automatically comes out of your bank account on the 1st of every month, and it's $1,000 a month. And it's December 31, I'm sorry, it's the 31st day of the prior month, and you're trying to figure out how much you can withdraw out of your bank account. Well, what you're going to do, probably, hopefully, is going to say, well, tomorrow $1,000 is coming out, so I need to leave at least $1,000 in. So even if my bank account shows $1,100, I'm going to only take out up to 100. Because even though I can take out 1,100, I know soon it's going to drop. So I'm going to leave a cushion in my bank account to anticipate the future reduction in my bank account. Does that make sense? So that's what this does. And so it says in determining basically how low you can go, whether your capital account would go impermissibly negative, you adjust such partner's capital account. Now, these are not actual adjustments. These are pro forma adjustments or hypothetical adjustments, because none of this stuff has happened yet. You don't have to worry about 4 or 5, 4 dealing with oil and gas, 5 dealing with stuff you don't have to worry about. 6 is the one. So again, you can annotate your code, just cross out 4 and 5. We're really worried here about distributions. We're going to take into account distributions that is at the end of the current year reasonably are expected to be made to the partner to the extent they exceed offsetting increases such partner's capital account. So what does that mean? That means that we're going to use our crystal ball and we're going to say, okay, determining how low we can go, we're going to look into the future and say, okay, partner that we're dealing with, are you expected to receive distributions in the future that would exceed increases in your capital account? So it's not just distribution. Let's think about something. If we expect to have profits in the future and we're going to distribute those profits, well, then we're not going to have problems because the profits will increase your capital account, distributions will reduce it, and it'll just be up and down and it won't have any effect. So we're worried about distributions that are not matched by capital account increases. So they may have think of any examples of a situation where you receive a distribution in the future that's not matched by a capital account increase. Again, distribution of future profits, that's not a problem. How could you receive distributions without also receiving a capital account increase. Well, what if the partnership borrows money and then distributes the money to you? They borrow against appreciation in property. Borrow against future business prospects. Well, then borrowing does not create gross income. So you would get a distribution of those proceeds that wouldn't be matched by a capital account increase. Or a new partner could come in and just contribute a bunch of money, and then some of that money is used to distribute to the old partners. That also would not be matched by a capital account increase. It would just go down. Okay, so we're going to build up our capital account, or to account for, or cushion our capital account to account for these future distributions. So this is illustrated in example 5, example 1, 5 little i's. Going back to our example. The one we skipped over, one of the ones we skipped over. So we have 20 of depreciation in year 2, 20 in year 1, and 20 in year 2. So our capital account at the end of year 1 is 40 and 20. And our depreciation for year 2 is 20. So that by itself, I'm sorry, I want to do 6 little i's. Sorry, 6 little i's, same facts, 20. So without anything else, that allocation of 20 depreciation to A would be fine, because it would take A's capital account from 20 to 0, not below 0. But we also, at the end of year 2, when we're trying to allocate this 20, we have to look at our crystal ball and look for these distributions that may happen to A. And we use our crystal ball, and it's reasonably expected that we're not going to have profits the next year, but we're going to borrow 10,000 and distribute it 5,000 to each of A and B. And that's exactly the kind of distribution we worry about, because the borrowing is not going to increase the capital accounts. And so what this example says is, in determining how low we go, this is our actual capital account, we're going to pull forward this distribution for purposes of testing how low we can go. We're going to leave 5,000 of cushion in the capital account effectively. And so our capital account is only, A's is only 15 for purpose of seeing how low we can go. And so only 15 of the 20 of depreciation has economic effect under the alternate test. And so at the end of the year 2, A is going to have a capital account of 15 and not, I'm sorry, 5 and not 0. And then when this distribution of the borrowing happens, it's going to take A from 5 to 0. It's not going to have A go impermissibly low. So it's like you with your landlord, with your rent, leaving $1,000 in the bank account because you know it's coming out. And that's leaving 5,000 in his capital account because it's reasonably expected that it's coming out. And we can't let A getting below 0 is a problem because there's nothing to support that. It's non-economic. It's funny money, it's monopoly money once A gets below 0. Okay, let me, now we only have a couple minutes left. let me just tie this up. We're going to have to come back and do some more on this on Monday. But let me tie up one loose end. Let's go back to the alternate test. And now we can, I think, understand the QIO. So, okay, so that's fine. We have this reasonable expected crystal ball. Now we have the problem is that you can't expect everything. You can't anticipate everything that happens in the future. Strange things happen. So you may, at the end of the current year, use your crystal ball and say, yeah, I don't foresee any future distribution to worry about. But then lo and behold, weird things happen. You know, your property goes way up in value. You own a bunch of GameStop stock that skyrockets in value, and you can borrow against it quite easily. Probably not because it's so volatile, but hypothetically, assume you can. And so again, weird things happen. You can't anticipate everything. And so now this distribution happens, and lo and behold, the partner is impermissibly low. And you did all you could to protect it. You know the rent withdrawal is happening, but maybe there's some other direct withdrawal that is contingent that you just couldn't anticipate. So now your bank account is negative, problem. Your capital account is negative, it's a problem. So what do we do there? Well, that's this QIO. And the QIO says, here's the definition. The partnership agreement contains a QIO if and only if partnership agreement provides that a partner unexpectedly receives an adjustment or distribution in 6. So again, if they expectedly received it, we should have dealt with it up front, created a cushion. But now they unexpectedly happened, and so we couldn't create the cushion. We didn't know it was going to happen. But it happens, will then be allocated items of income and gain in an amount and manner sufficient to eliminate such deficit amounts as quickly as possible. So it's like code red, this partner is impermissibly negative because of this unexpected distribution. We're going to allocate to that partner positive items, including items of gross income if we don't have enough net income, as quickly as possible to get the partner back up to 0, or if they have an LDRO, the LDRO amount. So we're going to scramble and fix it as quickly as possible by driving allocations of income and gain to the partner who is now impermissibly low. We didn't get out in front of the problem, again, because we couldn't foresee it well enough. So we're going to fix it ex post, right? So this part 6 here, up here, is ex ante, building the cushion. We get out in front of it. QIO is we couldn't get out in front of it. Life's just too unpredictable. So we fix it on the back end. Okay. So we'll come back to QIOs for next class. We'll spend a few more minutes on the alternate test, but then we move on to substantiality. And then again, next Wednesday, we'll have a big review day where we'll review all this stuff again. Okay, well, we've run out of time. If folks have any questions, please, as always, don't hesitate to reach out via email, and we